Most people believe investment success comes from choosing the perfect asset, but history shows that outcomes are shaped far more by structure than selection. Asset allocation is the hidden framework that determines how your money behaves across different market environments. It controls losses during uncertainty and captures growth during opportunity. Without allocation, even good investments fail. In this video, you will learn how asset allocation balances risk and growth, and why it remains the most important decision an investor ever makes. Like and subscribe to keep learning disciplined systems that protect wealth while allowing it to grow over time. 1. Asset allocation as a system. Asset allocation is not a tactic but a system. It defines how capital is distributed across different asset categories so that no single outcome dominates results. Markets are unpredictable, but allocation creates predictability in behavior. Each asset responds differently to economic conditions. When one struggles, another often stabilizes the portfolio. Allocation removes dependence on forecasts and replaces it with probability. It allows investors to progress even when markets are uncertain. 2. Why balance matters more than selection. Many investors spend energy selecting individual assets while ignoring balance. Even strong assets can fail if overweighted. Balance ensures that success does not depend on one outcome. Growth assets drive expansion, while defensive assets absorb shocks. Without balance, volatility increases and confidence weakens. Balanced allocation smooths performance and protects decision-making. Investors who focus on balance stay invested longer and achieve better outcomes. Balance is not about limiting success, but sustaining it. It allows capital to grow without exposing it to unnecessary risk. 3. Risk is structural, not emotional. Risk is often misunderstood as fear, but in reality, it is structural exposure. Asset allocation manages risk by design rather than emotion. It determines how much downside the portfolio can absorb before decisions are forced. When risk is controlled, investors remain calm. When risk is ignored, emotions take over. Allocation defines acceptable fluctuation in advance. This prevents panic during downturns. Structural risk management allows investors to endure volatility without abandoning strategy. 4. Growth requires controlled exposure. Growth assets are essential for long-term wealth creation. Without growth, purchasing power erodes. However, uncontrolled growth exposure leads to instability. Asset allocation limits growth to a level that can be emotionally and financially sustained. This allows investors to remain invested during downturns. Growth works only when combined with patience. Allocation ensures growth assets contribute without dominating. It creates a stable channel for compounding to occur over time. 5. Stability enables long-term discipline. Stability is not the absence of movement, but the ability to remain consistent. Defensive allocation provides this stability. It reduces drawdowns and protects capital during stress. Stability supports discipline. Investors with stable portfolios make better decisions. They avoid forced selling and emotional exits. Defensive assets allow growth assets time to recover. Stability is what allows strategies to survive long enough to succeed. 6. Time and allocation alignment. Asset allocation must align with time horizon. Long time horizons allow more growth exposure because recovery time exists. Shorter horizons require greater stability. Misalignment creates pressure. When time is ignored, investors take inappropriate risk. Allocation should evolve as time passes. This shift is intentional, not reactive. Aligning allocation with time reduces stress and increases success probability. Time is a structural variable, not a guess. 7. Rebalancing maintains integrity. Over time, markets distort allocation. Assets that perform well grow larger than intended. Rebalancing restores structure. It enforces discipline by trimming excess and reinforcing balance. This process removes emotion from decision-making. Rebalancing prevents silent risk accumulation. It ensures allocation remains aligned with original intent. Maintenance is essential for system integrity. Without it, portfolios drift into unintended exposure. 8. Behavior is the hidden variable. Even perfect allocation fails if behavior collapses. Asset allocation must match behavioral tolerance. If volatility causes panic, the system breaks. Allocation should allow investors to remain invested under pressure. Behavioral alignment is more important than theoretical optimization. A sustainable allocation outperforms an aggressive one that cannot be maintained. Long-term success depends on staying invested, not maximizing short-term returns. 9. Adaptation without abandonment. Asset allocation evolves with life stages, goals, and responsibilities. Adaptation does not mean abandoning principles. It means adjusting structure while maintaining discipline. Growth gradually shifts toward preservation. This transition protects accumulated wealth. Allocation allows adaptation without emotional decision-making. Change becomes intentional rather than reactive. Flexibility within structure is a hallmark of successful long-term investors. 10. Allocation as wealth architecture. Asset allocation is the architecture of wealth. It shapes how capital behaves across decades. It balances growth risk and stability into one cohesive system. Allocation protects against extremes. It allows progress through uncertainty. Wealth is not built by prediction, but by structure. Allocation is that structure. When designed properly, it carries investors through every market environment with confidence and control. Asset allocation proves that lasting success comes from balance, not prediction. By structuring risk and growth deliberately, investors replace emotional decisions with disciplined systems. This framework protects capital during uncertainty and captures opportunity during expansion. Wealth grows strongest when supported by structure rather than speculation. If you want to keep learning how to build resilient long-term investment systems, then like and subscribe so you never miss insights that strengthen your financial foundation and long-term control.